Problem 9, that was the one we solved last. All right, okay. This is what I would do. I'll just quickly do a quick recap on what we said goodwill was, and doing consolidated financial 2 rules. I said rule number 1 is for you to add up line by line items that you have on the parent and on the subsidiary financial position. We went ahead to say the second thing to do is to use the principle of cancellation. Now, you see, the principle of cancellation is split into 2. The first thing you want to cancel out is investment in the ordinary shares of the subsidiary company versus versus the ordinary shares and other net assets of the subsidiary. Meaning that, for instance, in this question, we would have considered investment in ordinary shares of ESCO, 34,000. And because Pico only owned 75% of the ordinary shares of ESCO, we would have added the NCI, which we are told is measured as proportionate share of subsidiaries' net assets. We would have added that and would have cancelled that against the 25,000 ordinary shares of ₦1 in ESCO and the pre-acquisition retained earnings, which we were told is 7,500. Now, that is cancellation that is expected of you. Now, that cancellation will more than not give birth to what is called goodwill. Now, goodwill here represents to pay above the net asset. The class for a bit. Sorry. Let me go back to what I was saying. So I was saying, and then the second cancellation is that of any intra-group transaction. Now, because when we are consolidating, we are assuming that the NCI, the ESCO, the parents, they are all together one group, one company. Therefore, it will be impossible for the same company to trade with ourselves. Therefore, any intra-group transactions will be cancelled out. All right. Now, we said goodwill will arise at any point in time where the fair value of the consideration paid by the parent is an higher amount than the proportionate share of subsidiary net asset that was acquired. Now, that is very straightforward with the question we've solved. Last week, I was telling you that when NCI is measured at proportionate share of subsidiary net assets, all of the goodwill belong to the parent. And I think I did a bit of calculation to show that to you, that whenever this is the measurement method, all of the goodwill belong to the parent. Now, should there be an impairment of goodwill, in this instance, it means that only the parent means that we are reducing the carrying amount of the goodwill. So we said that IFRS 3 mandated that annually you should review the goodwill on consolidation for impairment. The gist is still the same mentioned last week. When this is the method being used, all of the goodwill belong to the parents, and therefore we're going to do our double entry in such a way that we are going to debit group retained earnings, and then we're going to credit good. All right. And the reason we are doing it this way is simply because all of the goodwill belong to the parent. Now let's look at the next scenario. The next scenario, we're going to see the method of valuation of NCI is going to be the full or fair value. Now, if that be the case, the implication will not be the same as what we have here. It's going to be different. All right, let's pick the next question and let's demonstrate that. Okay. So we move to question 10. Where we still have impairment of goodwill, except that NCI is now valued at 75% of the ordinary shares of ESCO. Aisha?
Sorry.
Okay. PICO acquired 75% of the ordinary shares of ESCO on 1st January 2017, when ESCO had retained earnings of 7,500. Now, the market value of the shares of ESCO just before the date of acquisition was ₦1.60. Now, PICO values NCI at fair value. Goodwill is impaired by 20%. Now, we're giving the statement of financial position as at 31st December 2017. And then we're asked to prepare the consolidated statement of financial position of PICO at 31st December 2017. Okay? So, like I mentioned, let's do the workings together. When we want to do working is to ascertain the group structure. But before we go there, let me even set out what my solution would look like. I would have PICO, then consolidated statement of financial position, as at 31st December 2017. You would write your December in full in the example, right? Okay, I'll just leave that for now. Okay, let me, since it won't stay, let me do workings first. Okay, sorry, let me work on getting my second device so that I can read the question. Just hold on for me. I want to open the text on another. Okay, 9.10. All right. Okay. let's go ahead with, let me do the workings. So first thing first, group structure is such that ESCO is owned by both PICO and non-controlling interest. Now, PICO owns 75%, NCI is 25%. Sorry, I think the best method would be to use, just give me a moment, let me load the whiteboard. It's taking a bit of time.
Hello, sir.
Hello, I can hear you.
I don't know if you take note that somebody wrote a message there that she is just joining, or he or she, whatever.
Who's just joined? Okay, hold on a minute. Janet.
Sir?
Were you the one? I'm sorry, I'm trying to. Who was that? Okay, I'm just joining. This is my first class. Can you please summarize the previous so to this for clear understanding? It's okay. So, Janet, apologies. I didn't see your message earlier. Victoria, the same thing. So I didn't think you reached out to me before this class. I would have asked you to go back to the notes, I mean to the videos for the first two sessions we've had. It will be very hard to go back right now. So what I would advise is this. Just pay attention. After this class, you can always pick up the videos. Just ask for the videos on the group, and then I will share the link with you. Is that okay? Janet, Victoria, is that okay? All right. Okay, let's move on. Okay, so let's go back to the question. So I was already saying group structure is such that group structure is such that ESCO, there is PICO 75%, and we have non-controlling interest, definitely 25%. All right. Now, next thing I should consider is what is the date of acquisition? The date of acquisition, according to the question, was 1st January 2017, while the consolidation date was 31st December. I have told you. How do I know my consolidation date? Very easy. I will know my consolidation dates by looking at what date am I required to do the consolidation. The question says I am required to prepare consolidated statement of financial position as at 31st December 2017. Therefore, my consolidation date is that same date, 31st December 2017. Okay, now let me calculate my goodwill. My goodwill, I'll say purchase consideration. Purchase consideration. Now, what is investment in NCI? When you're looking at the financial position of PICO, investment in NCI, investment in ESCO is 34,000 naira. Then we come to NCI. We were told to value NCI at full value, and we had been told that the shares of ESCO were selling at 1.60 naira. So I'm going to say 25% of the ordinary shares of ESCO, which is 25,000 shares, multiplied by 1.60 naira. Now that should give me how much? How much should that give me? Please, if you have your calculator next to you, just help me calculate. 0.25 times 25,000 times 1.6. It gives me 10,000.
10,000.
Okay. Now I will subtract net assets that was acquired. All right. Now, ordinary share capital of ESCO is 25,000. The retained earnings as at the day of acquisition, the pre-acquisition retained earnings was 7,500. There was no other net assets that was acquired as of the day. So if I do this, my goodwill will be how much? Looks like 11,500 to me. All right. Someone told me that goodwill was impaired by 20%. Okay. Now, if goodwill was impaired by 20%, I'll say impairment. 20% times 20% equals 2,300. All right. Now, if I deduct that, how much do I get? I get 9,200. Now, can I say something here? This 2,300, how do you think we should treat it? What do you think should be the double entry for this 2,300? Before you go on, go ahead.
We'll credit the goodwill. Can you hear me?
Yeah, I can hear you, Latif.
We'll credit the goodwill and we'll debit the retained earnings of both the parent and the NCI.
All right, thank you. If I may ask, Latif, why do you think we also should debit NCI?
Based on what you have taught us, that since the goodwill is valued at not proportionate share, the other one. So definitely the goodwill,
fair value.
Fair value. So definitely goodwill will be borne by both the parent and the subsidiary.
No.
All right. All right. Thank you. Thank you. This is what I was referring to. Now let's look at it together.
Peace.
Oh, did I just close the whiteboard? Okay, now back. Look at what I want to show you here. Let's do the calculation together. The parents paid 34,000. Abby?
For buy beans. Ah.
Who is buying beans?
Make it for buy beans for me now.
Who is buying beans in my class? Sorry. The net assets that was acquired was 32,500. Somebody help me do this math. How much do you get when you do 75% of 32,500? 75% of 32,500.
That's 24,375.
Good. Now minus that from 34,000.
So that's 9,625.
Beautiful. 9,625. Now, if you look at this, this is the difference between what the parent has paid for 75% of the net asset they acquired. 9,625, meaning that this is the goodwill that we must have realized in the first question we treated last week. Now, but if you look at NCI as well, NCI has paid 10,000. I mean, it's valued at 10,000 naira. If you do 25% of 32,500,
8,125.
8,125. Now do 10,000 minus 8,125. I hope you are all following in this class.
1,875.
Okay, good. 1,875. Good. Now, if I add these two together, I should have 11,500. Is that what you get?
Yeah, yeah.
Did you see how that 11,500 is split now? If we do separate workings to derive goodwill that is attributable to parents and goodwill that is attributable to non-controlling interest, if we add those numbers together, we are still going to come back to 11,500. And that's to tell you that NCI has a share in the goodwill whenever it is valued at full or fair value. Now, if it is valued at full or fair value, the only instance where they will not have a share in the goodwill, it will mean that the value is equal to the proportionate share of the net assets that has been acquired, which is rarely ever the case. I have told you the market value of shares will most likely be higher than what is in the book of the company. So more often than not, I am sure 99.9% of the time, whenever they tell you NCI is measured using full or fair value, you will always have a goodwill that should be split between the two of them. Now, even if I was to do 75% and 25% of this 11,500, I am sure I will get 9,625 and I will get 1,875 here. All right. So it only makes sense that if NCI has a share in the goodwill, then when I will be making my adjustment for impairment of the goodwill. Now, when there is impairment, ordinarily it should go to your profit or loss account. But like I said, we are not dealing with profit or loss account. Now, what is the representation of your profit or loss account on the financial position, on the statement of financial position? Anybody can still recall that? Retained earnings, God bless you. So therefore, it will go to retained earnings. But when we go to the retained earnings, will only be the portion that belongs to the parent company. All right. So my consolidated or my group retained earnings will go like this. I am going to have PICO, I am going to have ESCO. Now, what is the retained earnings? For PICO, retained earnings for PICO, according to the question, was how much? It says 35,000. Retained earnings for ESCO, it says 12,500. Now I'm going to take out pre-acquisition retained earnings of how much? 7.5. All right. Now, don't you forget also that there is goodwill impairment. Now, that goodwill impairment will not only affect the parent. So therefore, unlike the last under PICO alone, instead I'll put it under ESCO. I'll make that adjustment under ESCO and say minus 2,000 is whatever is going to share two of them. What do I have left at the end of the day? For ESCO, what do we have left? 12.5 minus 7.5 minus 2,300. Sorry. Okay, I think where we are, we're trying to do the group retained earnings. We have spoken of PICO, we're speaking of ESCO. Now, their retained earnings as of 31st December 12, 2017, these are 35,000 and these are 12.5. So we said the pre-acquisition retained earnings, which was as of January 1st, 2017, was 7,500. Now, the parent company will have no share in that. So therefore, the group will not get that. But we said the goodwill impairment should affect both of them. All right. So we take out the 2,300 under ESCO. And at the end of the day, I think we should have 2,700 here.
700.
So now PICO's share will be, that's what we want to consolidate there. It will be 75% of 2,700. 75% of 2,700. Sorry.
2,025 naira.
That should be 2,025 naira. And everything here totals 37,025 naira. Now, as for NCI at acquisition, we valued it at 10,000. Now, the share of profit will be 25% of 2,700. Okay? What is 25% of 2,700? That should be 675. Abi? Am I correct?
675, correct.
And that will be 10,675. I have a chat. Okay, thank you, Alexa. All right, now, if you look at your solution, let's look at it together. I'll just stop sharing this.
Hello, sir.
Hello, I'm with you.
At that of 2,025 naira, right? You added it to 35,000.
Yes.
Yes.
I think you should less it now.
You have a problem there?
Yes, I think you should less it.
Why are we going to less? No, we won't do that. Why do you think we should less, first of all?
Since it is... Oh, sorry.
Do you understand now?
Yeah.
We have made all adjustments under ESCO. This is the profit that is left, and that is what will be shared between PICO and NCI. Now, another way we could have gone about this, let me just quickly show you. Maybe that is your line of thought. Or maybe somebody in the class is thinking like that. We could have done for group, we could just have said, PICO, ESCO, right? 35,000 here, 12,500 here, all right? Are we together? Now,
yes,
this is as at 31st/12/2017. On the date of acquisition, ESCO had 7,500, Abi? So we could have said, this is the post-acquisition profit of ESCO, Abi? And what do we do here? We share this 5,000 between PICO and NCI. So PICO share of 5,000, 75% of 5,000 should be 3,750, all right? But don't forget that there is a goodwill impairment. Now that goodwill impairment, ESCO owns 75% of goodwill. So it will also suffer 75% of the impairment of the goodwill. Okay? Now, let us do 75% of 2,300. Are we together?
Yes, sir.
1,725 naira.
1,755 naira.
25.
Now, we can make this deduction. Okay? If we make this deduction, what do we have? Meaning, I will add 35,000 plus 3,750 minus 1,725.
2,025.
Now, add 2,025 to 35,000.
So how much?
To 35,000. Don't forget, Pico had his own retained earnings. Thank you, Alexa. 37,025, which is the same thing that we had. Okay? So if I did the same thing for NCI, I'll just have said NCI is 10,000. The share of profit would have been the remaining 25% on 5,000, which should be 1,250. Now, somebody do 25% of 2,300. What do you get?
575.
5.5. Now, take away 575. If you take away 575, what do you get?
10,675. 10,675.
Now, did you see that it's the same amount that we have? So the reason I am not doing this method or doing it like this is because I want you to get rather used to this method, where what I would do whenever I'm doing my adjustment for group retained earnings, any adjustment that is supposed to affect PICO and ESCO in the proportion of their holdings, I am going to put it under ESCO. If it was to affect parents alone, I am going to put it under PICO. Is that clear? Is that understood?
Yes, sir.
All right, good. Now, I'll stop sharing for a bit because I want you to look at the book. Okay. Now, if we go to what was done for solution, you can see the group retained earnings was 37,025. NCI was this as well. All right. And now the goodwill was 9,200. Do you understand? Is that understood?
Yes, sir. Yes, sir.
Okay, so is it clear? Can I move on now? Do we see the treatment of impairment of goodwill when NCI is valued at proportionate and when NCI is valued at full or fair value? The implication of the treatment is different. I said for proportionate share, we simply debit group retained earnings and credit goodwill. Okay. While for full or fair value, we debit group retained earnings. Because NCI has a share in the goodwill, we debit NCI by the portion or the percentage of their holding, and then we credit everything to goodwill altogether. So it's as simple as that. It doesn't get simpler than this. So let's move on. The next thing on the agenda is a case where we have a negative goodwill. What if we calculated goodwill and we got a negative number? Now, that negative number, what it means is that the fair value of the...
Has a problem. I don't want to get nasty with you this night. Stop biting your lips.
Madam Aisha, can you please help us mute? All right. you recall that whenever we have goodwill, I said we are having that goodwill because the fair value of the purchase consideration and the NCI put together is greater than the net assets of the subsidiary that was acquired. Okay. However, you could also have a case where when we add the fair value of the consideration plus the NCI, we come to a value that is less than the net asset of the subsidiary. Now, should that be the case, you would have a negative number as your answer. Now, you will be tempted to say negative goodwill, but the standard IFRS 3 business combination does not call it negative goodwill. It calls it gain on bargain purchase. Now, we have two instructions or three whenever this happens. Look at your screen. You see, I want to read out this important information. In the case where the net asset acquired is higher than the amount transferred by the parent and the value of NCI, IFRS 3 business combination describes the difference as a gain on bargain purchase. Now, when the cancellation of the purchase consideration against the net asset acquired results in a gain on bargain purchase, the parent company must, number one, reassess the amount at which it has measured both the cost of combination or consideration transferred and the acquiree's identifiable net assets. Now, if this exercise should identify any errors, any excess remaining should be recognized immediately in profit or loss. Now, let me quickly explain that. It's highly uncommon. Shouldn't be the case if everything is okay with the company you're acquiring. What you should have is goodwill. Okay, but if you now see a case where it results in a gain on bargain purchase, IFRS 3 is encouraging you to do a reassessment. Go back, revalue, and revalue everything. Go back to your calculation all over again. Because it shouldn't really be the case, but okay. Now, if you have done all of that, you've corrected any errors, but you still find a gain on bargain purchase, what you should do is to recognize it as a profit under parent. Now, why are we recognizing that profit solely to the parent? It's because it is the parent that has made the purchase. It is the parent that has done what? That has made the purchase. Now, when we have goodwill, what do? We recognize the goodwill as an asset on the consolidated statement of financial position. Assets, right? But when it is a gain on bargain purchase, don't recognize it as an asset. What do you do instead? Take it to group retained earnings, and there it will belong solely to the parent company. You are not going to share it to the NCI. Is this clear? Is this clear? Ahmed, go ahead.
I appreciate it. You can come in.
Okay, I'll come again. Now, in the previous example, we had goodwill on consolidation. And why we had that was because we said that the fair value of the consideration, when we add purchase consideration plus NCI, what we get is an amount that is greater than the net asset of the subsidiary. Okay? Whenever this happens, you're going to get goodwill. But if reverse is the case, where when we add the purchase consideration and the net controlling interest, we get an amount that is less than the net asset of the subsidiary. What you will have is gain on bargain purchase. Okay? I'm now saying you are used to this statement. Whenever it is goodwill on consolidation, after the casting out, we're going to recognize it as an asset on the statement, on the consolidated statement of financial position. Okay? You are used to that. But you have a different treatment here. Don't recognize any asset. What you should do is take it to the group retained earnings. But you are not going to share it. You will not share this gain with NCI. You will not share it with NCI. It will only be under PICO, meaning only PICO has all of this gain on bargain purchase. Because if it's a bargain purchase and we have made a gain, who purchased? Who made the bargain purchase? It was the parent that acquired the subsidiary. So therefore, all of those gains should be under PICO. Okay, that's the question. Is that understood before I move forward? Is it clear? Alexa, is it clear? Latif, is it clear? Aisha, is it clear? Jamil, is it clear? Esther Babalola.
Hello, sir.
Go ahead, Mr. Latif.
We appreciate your explanation very well. Oh, thank you for that. However, we would love if you can just put a note later after the class. You drop it on the chat as regard that, so that we can go through it again.
Okay. Okay. Oreoluwa, how far? Do you understand?
No, sorry, this is Aisha. It's not too clear, sir.
Okay. All right. We'll demonstrate it with the question. Let's just move on. I'll demonstrate it. I'll point it out when I'm dealing with the next solution now.
Okay.
Okay. So permit me to do the solution on the screen whilst you are looking at the question. All right. Okay, problem 11, gain on bargain purchase. PICO acquired 75% of the ordinary shares of ESCO on 1st January 2017, when ESCO had retained earnings of 7,500. The market price of the shares of ESCO just before the date of acquisition was ₦1.30. Now, PICO values NCI at fair value. Goodwill is not impaired. Statement of financial position as of 31st December 2017, both PICO and ESCO, as given to us, we are required to prepare the consolidated statement of financial position of PICO at 31st December 2017. Okay, we already know the gist. The group structure is such that if this is ESCO, PICO owns 75% of the cake, NCI owns the remaining 25%. All right. Now, date of acquisition is January 1st, 2017. Date of consolidation is 31st December 2017. Now, I am to first Now, what is the purchase consideration? The purchase consideration we have is an amount. If you look at PICO, investment in ordinary shares of ESCO, you see 24,000. NCI is valued at full or fair value. So therefore, I would say 25% of how many shares do we have in ESCO? 25,000, okay? 25,000 multiplied by 1 naira. What do we get?
8,125.
8,125. Now, if you add this, you get 32,125. When you come and calculate net assets that was acquired, ordinary share capital is 25,000. Pre-acquisition retained earnings. Pre-acquisition retained earnings is 75. That gives us 32,500. If you calculate the difference, you get a negative 375. Or is it not negative? It's definitely negative, right? Now, this negative 375 is not going to be called negative goodwill. I said, if you have this scenario, you will call it gain on bargain purchase. Is this clear?
Yes, sir.
Okay. Now,
Hello, sir.
should that now be the case? If you look at it, it means that in this instance, we have an underpayment. Underpayment not because they have not paid all they ought to pay or all they want to pay, but because the net asset is even higher than the consideration plus NCI. So I said this gain, it belongs to the parent. All right. Now let's see how this was treated so that we can easily move on. Let's see how this was treated. Of course, PP was added together to make 55,000. And I'm sure current assets was added together as well to make 53,500. That settles assets. We're going to cancel out the investment in ordinary shares of ESCO. Now let's come to the workings. Let me show you. You see, 375, right? Let's look at the group retained earnings. Where do you see the 375? You would find it. I have a chart.
Gain on bargain.
Sorry. Alexa, is my voice still fluctuating?
Sir, it's network.
Okay. Okay. All right. So we find this 375 here solely under PICO. That is the treatment. There's nothing more than that. Every other thing here, pre-acquisition retained earnings, we've dealt with all of this before. So this is the only new thing that has been introduced. Okay, is that clear? Is it clear to us? We can use the chat box or we can unmute. I want to be sure we are following.
Yes, sir. Yes, sir. Only that
Yes, sir.
hello, sir.
Go ahead.
Okay, only that you don't put your eyes on the message chat immediately as the message comes,
Okay.
because exactly like Aleza did that, she noted that the network was not fine there, but you didn't look at the message that hour.
Oh, sorry. It's because my eyes is on the screen I'm sharing. So I am not observing that there's a new, but anyway, just call my attention to it. Thank you very much. Thank you. All right. Let's move on. Let's solve one more. So let's see what the next problem is. Oh, beautiful. Our next problem has to do with the mode of the consideration. What kind of method is our parent using to pay? So now there are a number of ways. It is not all the time that the parent will settle acquisition with cash. You might have instances where that will be done using other means. It could be contingent and deferred consideration. Now, let me quickly differentiate between these two. Okay. When we say deferred consideration, it means that the parent has promised to make a payment in the future. That's all. At the future date, they are expected to make a payment. So for instance, if it is valued at 15 million, parents may say, let's say NCI net asset is valued at 15 million. The parent company might have paid 10 million today, and then the remaining 5 million will be paid on the 31st March 2026. This is deferred. Deferred just means you are pushing something into the future. However, contingent consideration means that here we are going to pay at a future date. In fact, we may have chosen the same 31st March 2026, but there is a condition that must be met before parents will make a payment. Now, if this condition is not met, then the parent would not have to make that payment. For instance, the agreement may be that if the subsidiary is able to make a profit, post-acquisition profit, will there be fluctuating effect in the YouTube link that will be shared, or will it be fine? Victoria, I really do not know. I really do not know until it is shared. But it's a recording of the class. If from my own end there are no issues, there won't be issues on the video. All right. I don't think there should be any issues. I'm not sure, but we'll see. Let's just wait and see. All right, Victoria. Okay. Now, the condition may be that the post-acquisition profit, if it was up to 10, let's say very simple case, 100,000. If you have a post-acquisition profit of 100,000 as of these dates, then we'll pay you 5 million. If you don't, if you have any amount less than this, and then we will not pay you. Now, that is contingent. It is contingent because it depends on a condition or conditions. But deferred does not have any condition. Is that understood? Now, the same way that I have differentiated this.
Sorry, sir, please, can you recap on that word you said?
Okay.
Your
In
last
a
statement.
nutshell, is that Janet? Okay. In a nutshell, what we are saying is this. If there is a case where the parent has promised to make a future payment, a payment at a future date, and it is dependent on some conditions, then we have contingent consideration. But if the parent has said, I'm going to make a future payment, I'm going to make a payment on a future date, but you can be sure you will get that money. Then it is not dependent on any condition. Then it is simply deferred consideration. So both of them are payments at a future date, only that contingent consideration is dependent on some conditions, whilst deferred consideration is not dependent on any condition. Now, that condition is going to be agreed by both parties. That is, the acquirer and the acquiree. They would have both agreed on that condition. And if that condition is met, then the acquirer will have to make that payment at the future date. If it is not met, then they are no longer liable to make that payment. Is it clear now?
Yes, sir, it's clear.
All right. Now, that said, it is fantastic that we are able to do this. However, in terms of treatment, when we are making our adjustments, whether it is contingent or it is deferred consideration, it is the same treatment. Is that clear? It is the same treatment. Okay? Now, what did IFRS 3 say about this? The guidance we have is simple. The guidance we have is this. Whenever there is a deferred or contingent consideration, we are asked to do two things. Number one, we are to recognize the present value of the deferred or contingent consideration. Then number two, we are to unwind the discount the discounts. Now I'm going to show us. Okay, I think I'm going to end it here. When I say I'm going to end it here, I will solve this question in the next class so that we'll begin with that and I'll have everybody on board. There will be no fluctuation by God's grace. Now, when I say present value of deferred or contingent consideration, this is what I mean. You are going to calculate using this formula, present value equals future value, open bracket, 1 plus r raised to power of minus x. Grace, can you please help us mute? Where PV is present value. FV is future value, that is the consideration. that will be paid in the future. R is the parent company's cost of capital. Cost of capital. And N is the number of years. Now, in unwinding the cost, this is what it means. I am going to use the cost of capital. I am going to multiply it by this present value. It will be my annual or periodic finance cost. It will be my annual or periodic finance cost. Now, this is my suggestion that we start with this question next class. Quite fatigued, but if we choose that we are ready, we want to go on, no problem. I can go ahead and we'll solve this. No wahala. Let's make a quick vote. Should we continue or should we begin the next class with this? Use the chat. Okay, no problem. We'll end it here. We'll pick it up from the next class. Okay, Ahmed has been. I've also had network problems a few times, but that's not my reason. My reason, I'm just fatigued somehow, and I don't trust that if we go into this question, I will not have to recap many times. All right, okay. But did we understand the two problems that we have solved in the class? The two problems we solved, we've demonstrated when there is impairment of goodwill and NCI is measured at full or fair value. We've also looked at when there is negative goodwill, which I said IFRS 3 refers to as gain on bargain purchase. Okay, I want to believe we all heard my explanations there and we all understand. Okay, the next class, we're going to take it up from here. As for Janet and Victoria, apologies. Please pick up the last two sessions videos. Is on our YouTube channel. And this is for all of us to subscribe to the YouTube channel. Like Mr. Wasu always say, if you're already subscribed to the YouTube channel, you're going to always get notifications from us. All right. Now, for Janet and for Victoria and any other new member of the class, if you look at the videos and you're still not clear about one or two things, please, you have my number. This is my phone number. I'm also on the group. Chat me up. Let me know so I can point you or maybe have a quick session with you to give explanation. Okay. That does not leave out any other person, even if you've had the classes together. There seems to be an area where you don't get. Please always let me know. Thank you very much for your time. I'll see you